In this video, we're going to talk about the mother of all crashes that's coming up in 2022. This was predicted by Michael Burry, the man who predicted the 2008 housing bubble crisis. Hey, what's up guys? My name is Chase and this is a Penny Pincher's Guide to Personal Finance and Investing. Go ahead and hit that like and subscribe button so you can get more videos and more information just like this. Let's jump right into the video. So that's right, Michael Burry himself has said that stocks and cryptos haven't come close to hitting the bottom yet. He actually is saying that he suspects that they will go down another 50% before they hit their total buy. And so this hedge fund manager, the guy who was become infamous from the Big Short movie, who predicted the 2008 housing market crash and at the same time made a whole bunch of money with that, he is predicting that we are nowhere near the bottom. And so basically he puts out this information on his Twitter. And if we take a look right here, you can see this is actually, he is very famous for putting up a tweet and then immediately deleting it. But this is actually a Michael Burry archive where they will take some of the tweets that he will tweet and then they will actually retweet them and place them onto their Twitter right here. And you kind of go through and you can see some of the stuff he's recommending. But he was saying in one of his tweets that he believes that we are not near the low, that we're going to be seeing a even greater decrease in the total S&P 500 and in the crypto markets as a whole. And that, I mean, that's awesome. He goes onto Twitter, he criticizes stock valuations, crypto bulls, and overall the reckless investor behavior and talks against that. But he is now warning crypto investors that the mother of all crashes are coming. And now that he's saying that, in that particular tweet, the S&P 500 has dropped more than 12%. Blue chip index is down over 21% over the last 6 months alone. But now even recently he's saying that this could not even be the worst. It could get even worse from there. So he went on to say that adjusted for inflation, the 2022 first half S&P 500 is down 25 to 26%, and the Nasdaq is down 34 to 35%. Bitcoin is down about 64 to 65%. We're seeing that from its highs up from the 60s and 70,000s. Now it's hanging around to the 20,000s. And a lot of people are saying that if it continues to go down, we could see a greater downturn of the crypto market. He thinks that there are multiple compressions that are leading to this particular outcome in the markets. And he's expecting that the next earnings compression will make it even worse, and that will actually lead to the halving, the 50% additional decrease in the total stock market. And this is kind of scary because if he is correct, then that means that the S&P 500 has another 25% to fall, even after it has already logged one of the worst performances since 1970. And because of that, the index could drop as low as 2,800 points this year. Now, overall, that is a pretty substantial dip, but it's not as bad as what Michael Burry predicted back in May when he argued that the S&P 500 could actually sink as far as 1,862 points based on his analysis and past bear markets. Now, I do think that's fair, but honestly, if you look at one of his tweets, he's actually said in the past that he believes, that based off of his analysis and what he's looked at that, he expects these numbers to occur. But when you really dive down deep into it, it doesn't come up with any sound evidence that will determine why he believes that this is happening. And even to the point that Elon Musk has said that he basically is crying wolf, and that he is basically a broken clock. And that was actually tweeted by Elon Musk, and so there's obviously some butting heads going on. He is actually predicting more downside ahead of the stocks. George Ball, chairman of Sanders Morris Harris, a Houston-based investment firm with $4.9 billion in assets under management, told the Fortune that he sees the S&P 500 falling to 3,100 this year, and the Federal Reserve continues to raise interest rates in its battle against inflation. And so him in conjunction with Burry are saying that they don't believe that this is the bottom of that, and that may be true. But what I want to talk about is how if you were following along with Michael Burry and you were listening to what he was doing, there's a couple different key points where he was talking about there is going to be a massive bear run, and it actually went up. So this is actually back in 2017 at the very bottom of where the the actual low was for 2017, he was saying that it was just getting started and it was going to continue to go. And if you had listened to him and not invested during this time, or not continued to invest, or just held off, then you would have missed out on a giant bull run that happened from 2017 up until the 2020s, where we saw that huge increase in the market. So at the same time, while you're listening to some of these technical analysis associated with them and these big hedge fund investors that are saying that there are some big outcomes that are going to be occurring with the crypto market as well as with the stock market, I don't think that you should be listening or basing your analysis on some information from the past, what's going to be happening at this time, just because of some big hedge fund manager that came up with this great idea back in 2008 that actually ended up making him a lot of money. Well, in the end, actually, that whole process of the housing market collapse was actually over a 2-year span, and it took him that long for what he was saying to actually come to fruition. And so in some sort of way, if you think about it, if you're saying something, eventually that will eventually come true. And so as of right now, I don't necessarily think that everything that he's saying has as much merit as some people are putting into it. Yes, maybe that we will be seeing a drop in the markets as a whole, but that doesn't necessarily mean that's going to occur right now. That could potentially happen, 6 months, a year from now, 2 years from now. And because of that, and we never really know, then I would actually recommend, not trying to time the market, right? We always talk about dollar cost averaging in, buying in a little bit at a time. So because no one out there can time the market, no one can find that bottom and invest at the exact same time. And because of that, the majority of the people out there that are trying to time the market comparatively to the ones that are trying to, steadily invest, I would bet that the people steadily investing are going to, majority of the time, win out against a lot of those people that are trying to time the market, just because we cannot fully time the market the way that you want to. So in the end, there's going to be a majority of people out there that are going to have a better outcome from investing on a regular basis compared to trying to time the market as a whole. Because in the end, the best option for you right now is to continue to stay employed, continue to make as much money as you can right now with your job, and investing on a regular basis and saving up for when there is going to be that low, for whenever you are going to see that little drop, you can continue to invest and make that long-term investment down the road. Because in the end, it is how long you are in the market. It is not when you get into the market that's going to make you the most of the money. And with that being said, thank you so much for watching this video. If you are enjoying it, go hit that subscribe button. I really do appreciate it. I hope you have a great day. And as always, we want to remind you that we are here from your first penny to your first million. We'll see you next time.